What caused the great inflation of the 1970s? Imagine a time when prices kept climbing, and money seemed to lose its value faster than ever before. That period is known as the Great Inflation of the 1970s, and understanding what led to it can teach us a lot about how economies work. It all started with the way governments and central banks managed the economy. During this time, the Federal Reserve, which is the main bank in the United States, used policies that made money easier to borrow and spend. They believed that increasing the money supply would help lower unemployment and boost growth. This idea was based on a theory called the Phillips curve, which suggested that inflation and unemployment had a trade-off. Policymakers thought they could keep both low, but they underestimated how much inflation would rise. At the same time, the government was running big budget deficits, meaning it was spending more money than it was collecting in taxes. To cover this gap, the government borrowed money, which added to the total amount of money in circulation. This extra money made inflation worse because there was more cash chasing the same amount of goods. But things got even more complicated when energy prices shot up sharply during the oil crises of 1973 and 1979. These sudden increases in oil costs made everything more expensive, from gasoline to factory goods. This kind of inflation, called cost-push inflation, happens when production costs go up and businesses pass those costs onto consumers. The Federal Reserve's response was not quick or aggressive enough at first. They believed that inflation was temporary and that the economy could handle more money without spiraling out of control. They also faced pressure to keep unemployment low, which made them hesitant to tighten policies. This delay allowed inflation to build up over several years. The situation worsened because many policymakers relied on flawed data and misunderstood the true causes of inflation. They thought inflation was mainly caused by too much government spending or external shocks, not realizing that the excessive growth of the money supply was a big part of the problem. It was only when Paul Volcker became the Federal Reserve Chairman in 1979 that the central bank took strong action. They sharply raised interest rates and reduced the growth of the money supply to bring inflation under control. This caused a deep recession in the early 1980s but ultimately restored price stability. So, the Great Inflation was caused by a mix of overly loose monetary policies, government deficits, external shocks like oil price hikes, and mistaken beliefs about inflation's causes. It shows how important it is for central banks to carefully manage the money supply and respond quickly to signs of rising prices. The lessons from that time still influence how central banks approach inflation today.